Welcome back to the deep dive. We're here to crack open those dense corporate filings again.
Yeah, find the stories hidden inside, the stuff you can actually use.
And today we are tackling CVS Health's Q3 2025 results.
It's a really important one to unpack this time because, well, the headlines just don't seem to match up at all.
They really don't.
Yeah.
I mean, you look at the press release highlights and it looks fantastic, right? Record quarterly revenue.
Huge number, $102.9 billion.
Exactly. And they even raised their guidance for core earnings. The full-year adjusted EPS outlook is up now, $6.55 to $6.65. Looks great.
But then, yeah, you flip over to the official GAAP numbers, and it's a disaster on the bottom line. A diluted loss per share for the quarter of negative $3.13.
Okay, so that's the mission today. How does that happen? Record sales, better core earnings outlook, but a multi-billion-dollar loss. We need to figure out what's driving this, separate the cleanup costs from the actual business health.
Is the underlying engine okay? Or is this just accounting maneuvers hiding a bigger problem? Let's find out.
Right. So that negative $3.13 loss per share. To get there, you have to understand the sheer scale of the cleanup in Q3. The net loss attributable to CVS Health was almost $4 billion.
$4 billion. Wow.
And most of that, nearly all of it, comes down to one huge non-cash accounting decision.
Which has got to be that massive $5.725 billion goodwill impairment charge. That's the number that just sinks the whole quarter, isn't it?
It really is. For listeners, remember, goodwill is basically that premium a company pays when they buy something above its tangible asset value. It reflects what they expect to earn from it in the future.
So writing down goodwill.
Precisely. This charge is tied specifically to their healthcare delivery reporting unit. That's within the health services segment.
Okay, so think Signify Health, Oak Street Health.
Yeah.
Those big recent acquisitions.
Exactly. Those assets they bought to build out their whole integrated care vision. So is this $5.7 billion write-down basically CVS saying, oops, we paid too much, or at least these things aren't going to be as profitable as we thought?
It's a very clear signal that the value they were carrying on the books for these units isn't supported anymore by the future cash flows they now expect. And what's really telling is that they flagged this risk earlier. During the annual test back in late 2024, the fair value for this unit was only about 8% higher than its carrying value.
Wow, that's cutting it fine. So the cushion was already tiny.
Very thin. So any pressure like higher costs or maybe higher medical utilization was likely to tip it over, and, well, it did this quarter.
And that single charge explains the massive swing in operating results, right? From, what, $832 million operating income last year?
To an operating loss of $3.207 billion this quarter. Bam. You see immediately why they prefer talking about the adjusted numbers.
Definitely shifts the narrative.
Though there was one slightly weird positive item offsetting some of this, a $483 million gain from deconsolidating Omnicare, LLC.
Okay, gain on deconsolidation. Sounds technical. But the story behind it is pretty rough, isn't it? Omnicare is their long-term care pharmacy business.
Yeah, and it filed for Chapter 11 bankruptcy in September, voluntarily. So because it went into bankruptcy, CVS could take it off their main balance sheet, which, bizarrely, creates this accounting gain.
Not exactly a sign of strength, gaining money because a subsidiary went bankrupt.
No, not typically. It's cleaning up the books, but through some pretty drastic measures.
All right, so we've isolated that huge GAAP loss, mostly the goodwill hit. Let's pivot now, like management wants us to the adjusted results. The adjusted operating income was strong, $3.459 billion, up almost 36%. It suggests the core operations are doing okay.
They are, but, to get to that nice adjusted number, they had to exclude a whole bunch of other significant costs this year. Think legacy legal issues, strategic cleanup.
How much are we talking about?
Year to date, through the end of Q3, they've booked over $1.2 billion in pre-tax charges just for legacy litigation. That's not just one thing. It's like they decided to clear out a lot of old legal baggage all at once.
Okay, $1.2 billion is still a really big number. What were the main components? Where did that come from?
Well, the biggest single piece goes back to Omnicare again. Remember the bankruptcy? There was a $929 million charge related to False Claims Act litigation over dispensing practices from, 2010 to 2018.
Hold on. If Omnicare is bankrupt and deconsolidated, is CVS still somehow liable for that, You'd think bankruptcy would shield them.
But not entirely. The parent company, CVS Health Corporation, is still what they call jointly and severally liable for $165 million of the penalties from that case.
So that liability doesn't just vanish with the bankruptcy filing. Good to know.
No, it sticks with the parent. That's definitely something investors need to track.
Okay, so besides Omnicare, what other old skeletons were rattling this quarter?
Well, there was another $291 million charge. This one was in the health services segment, related to how their PBM reported certain payments, direct and indirect remuneration, again going way back, 2010 to 2016.
More historical stuff?
And the opioid litigation isn't over either, another $320 million charge just in Q3 this year. It highlights how complex these settlements are, especially when, a state like Maryland decides not to join the main agreement.
Right. These things drag on.
Yeah.
And it wasn't just legal costs they adjusted out, was it? There were strategic moves, too.
Yeah, they're trimming assets. They took a $288 million pre-tax loss from winding down and selling off their accountable care operations. That's the ACO, REACH-EH, and MSSP businesses.
Another part of the integrated care strategy that didn't quite pan out as planned, it seems.
Seems that way, and this connects right back to the goodwill issue we started with. They also booked an $83 million charge specifically for closing some existing Oak Street Health clinics. Those closures are planned for 2026.
Okay, wait. Closing Oak Street clinics already? Oak Street was a huge acquisition, central to their care delivery strategy. Is this $83 million charge like the tip of the iceberg? Does it suggest that maybe the higher medical costs, the utilization pressures everyone's talking about, are already making some of these newly acquired clinics unprofitable?
That is the million-dollar question, or maybe the billion-dollar question here. It certainly suggests that scaling these models profitably is proving more challenging or expensive than maybe the initial valuations assumed. They're making cuts.
Okay, we've sifted through the financial cleanup, the write-downs, the legal charges. Let's look at the actual business segments now. If you ignore all that noise, how are the core parts performing? Let's start with Aetna, the healthcare benefits segment.
Yeah, Aetna actually looks pretty solid operationally. Total revenues were up 9.1% in the third quarter.
Okay, what drove that?
Mostly their government business. And specifically, they called out the impact of the Inflation Reduction Act, the IRA, on the Medicare Part D program. That helped boost revenue.
And crucially, their profitability on the insurance side, the underwriting, that seems to have improved a lot. The medical benefit ratio, the MBR.
Right, how much they spend on care versus premiums.
That dropped quite a bit, didn't it? Down to 92.8% from 95.2% last year. That's a good sign.
It is. That's mostly better performance in that government business again. Even with utilization being a concern everywhere, it seems Aetna managed its costs relatively well this quarter. Although they did mention higher acuity, like sicker patients, in the individual exchange market kind of limited the improvement a bit.
And the star ratings. That's always key for Medicare Advantage.
Still strong, mostly. For the 2026 plan year, over 81% of their Medicare Advantage members are in plans rated 4 stars or higher. That's down a bit from 88% for 2025 plans, but still a very solid number for securing future bonuses and enrollment.
Okay, good. Now, what about health services? This is the big PBM, Caremark, but also includes that healthcare delivery unit where the goodwill charge happened.
Right. So on the revenue side here, also strong growth, up 11.6% in Q3. That was driven by, drug mix shifting to more expensive drugs and just general brand inflation.
Makes sense. But the volume, the actual number of claims processed.
That actually dipped slightly, down 1.8% in Q3 on a 30-day equivalent basis. So revenue up, but underlying volume slightly down.
Interesting. And the profit here, despite the revenue growth, the adjusted operating income actually fell by 7.0% in this segment. Why?
Yeah, that's the key pressure point. It boils down to intense competition. They specifically mentioned pharmacy client price improvements.
Which means?
It means they're having to give back more of the savings, the rebates, and discounts they negotiate with drug makers back to their big clients, the employers, and health plans.
So they negotiate better prices, but competition forces them to pass more of that value along, squeezing their own margins.
Exactly. The PBM profit pool is definitely getting tighter. However,
this is a positive spin.
Well, they did have a really strong selling season. Caremark locked in almost $6 billion in new contracts, and their client retention rate is still way up there, in the high 90s. So they're securing future business, even if the margins are tighter.
Okay, that's important context. Finally, the retail side, pharmacy and consumer wellness.
Revenues here also grew nicely, up 11.7% in Q3.
What's driving that? Prescriptions?
Mostly, yeah. Prescriptions filled were up almost 7%. Again, 30-day equivalent. And part of that boost came from buying prescription files from Rite Aid as they restructure, so CVS is picking up share there.
Smart move, capitalizing on a competitor's weakness. But, same story on profit here, adjusted operating income was down 7.4%.
Correct. It's the same old story in retail pharmacy, really. Ongoing pharmacy reimbursement pressure. They just get paid less by insurers for filling scripts over time. Plus, they mention increased investment.
And the front store, the non-pharmacy stuff.
Basically flat, down 0.1%. So yeah, pharmacy volume is driving growth, helped by acquisitions, but the core retail environment seems pretty tough, probably reflecting, cautious consumers.
Okay, so let's try and wrap this up. What should you, listening to this, take away from CVS Health's Q3? It really feels like a story of a massive cleanup operation.
Absolutely. They took a huge amount of financial pain this quarter, that $5.7 billion goodwill hit, over $1 billion in old lawsuit charges, costs for closing clinics and businesses. It feels like they decided to just clear the decks.
Get all the bad news out at once, maybe.
Could be. But if you manage to filter out all that historical baggage and one-time charges, the underlying operational parts, especially Aetna and the PBM's ability to win contracts, they look pretty strong on the top line.
Which is why they felt confident enough to raise that core earnings outlook, the adjusted EPS.
Yeah.
They believe in the underlying machine, stripped of these legacy issues.
Right, but that shadow of the goodwill impairment and the Oak Street Clinic closures, that definitely lingers.
Which brings us to that final thought we want to leave you with. In the actual Q3 filing, the company explicitly warned.
Yeah, they stated the continued higher-than-expected utilization, basically. People using more healthcare, driving up costs, could lead to future impairment of goodwill.
So the healthcare delivery unit already took that massive $5.7 billion charge this quarter. We know they're closing some clinics.
And we know CVS still has over $85 billion in total goodwill sitting on its balance sheet as of September 30th. A huge amount.
So the provocative question for you is, if medical costs keep rising and put more pressure on the profitability of all those healthcare assets they've bought, how much risk is there that they'll need another big write-down, possibly a massive one?
Is this Q3 charge the end of the cleanup or just the beginning? That's something to keep a very close eye on.
That's the potential ticking clock on their balance sheet. Thanks for joining us for the deep dive. We'll be back soon to unpack more data.